you don't need to leave your job to start a business, but rather you need to start a business in order for you to leave your job. Welcome to another episode of Financial Literacy by yours truly, Johnson Galabuzi, your financial expert. Like we agreed last time, I'll be doing a series of episodes to show us how we can improve ourselves financially. Sometimes we make mistakes, get a bit anxious, and then leave the job and try to start something. More than sure, most oftenly, it will end up failing because you haven't gathered momentum to sustain that business. That is why today we'll be looking at the key ingredients, the key requirements that we need to be able to borrow from the bank, for starters, to be able to get your business running, to be able for you to be financially upright and stable. Now, the entry point for any individual in any business into the bank is the account opening process. That is not news to you because definitely if you're going to be part of the bank or part of the banking industry, you must have an account. And we have a lot of different types of accounts that are available. Banks are really innovating around that. That's where you find people being able to open online even without coming to the bank. All you need to open an account if you're an individual is a national ID. You walk into any bank of your choice these days, they no longer ask you for your mother, your grandmother, your children, and so on. If you have your original national ID, they'll open an account for you. That's just the starting point. And some of you already have the accounts. Good enough. But how do you use your relationship with the bank in order for you to grow your business? The million-dollar question, like I've already said, do you really need to borrow that money? If you really need to borrow the money, what's the purpose? And how sure are you that whatever you're going to invest that money is going to give you returns that will be able to give you profits where you'll be able to save and also pay back the bank? So it is extremely important. The requirements will be given to you and you will fulfill them. But do you really need to borrow? And that's where I'll come in handy to share with you if you need to borrow. But for starters, once you're an individual, your national ID, the account is opened, then you start to deposit and withdraw. It doesn't mean you're only supposed to save money continuously until you reach a certain target, unless if you have a target and you say, I'm saving for this particular purpose. But if it is a company, you have a running company, you have jobs that you are doing, for starters, they will need a memorandum of understanding or what we call the articles of association. Then you will get your national ID, the profile of the company, and then we'll look at the audited books if you have any, and so on. But usually, lending is not based on security. These days, lending is based on your cash flow. What is your cash flow like? Cash flow is pretty simple. It is what you bring into the business and what gets out, just like water flowing. So in there, they'll look at your cash flows. And if your cash flows can sustain a particular amount of borrowing, then most probably that is what they will look at and enable you grow that cash flow so that it's able to give you more credit along the way. Two, we look at the type of business that you're doing. Particular banks have particular niches of businesses that they focus on. Now, for example, the banks that are very good at asset financing. There are banks that are good at trade and finance. There are banks that are good at agriculture. Mention it. But again, in there, you need to understand when you borrow the money, it has to be paid back. It is pretty simple. If you have to pay back that amount of money, then it means whatever you're doing is supposed to generate enough cash flow for you to repay. Now, as a bank, at the end of the day, it will cover itself, it will have collateral for the amount of money that you have borrowed, and in case there is any form of default, most probably you will go and sort yourselves out in terms of how you liquidate the security. The most important thing in this mix is you need to borrow for a particular purpose where you're very sure that the money will be brought back, where you're sure that you have staked. But remember, usually the higher the risk, the higher the return. So in whatever you're staking, the money that you've borrowed from the bank, you need to look at what we call the risk acceptance criteria, which means that are you willing to take that particular risk in order for you to have a leap of faith, in order for you to get returns on that business. Remember, you're in a field where you're competing with people who have different sources of income. People have other sources of income. Some of them are trading in the same area with you, but they have other sources of income. So if you borrow a lot, and that is where financial literacy comes in, if you borrow based on what other people are doing, because they have a lot of capital, you also want capital to come in so that you look like your pump. That is the beginning of most of our challenges. Please cut your coat according to your size. It is extremely important that you understand why you are taking the money and how you're going to use it. And that's where we come to the element of saving and investment. Saving alone will not take you very far. You need a mix of both. You save the money, but also invest it. Now you'll be wondering, I'm not saving a lot of money. Where do you expect me to invest that money? There are very many investment vehicles that you can look at. Now, most of us think that investment is about rolling your sleeves and going and hustling to make sure that your money comes back. There are smarter ways of investing your money along the way. We know the unit trust, we have fixed deposit accounts in banks, we have a couple of, stocks that are being sold in the Capital Markets Authority, and so on. If you need another session about where to invest your money, we'll definitely talk about that. But for us today, we are talking about the major requirements for you to access credit in the different institutions. We have said, one, you need to have an account. Once the account is opened, that will create history. It doesn't mean that if the account is still new, they will not be able to lend to you, because most probably you've been, saving somewhere. So that makes it easy. They will request you for example, a 6-month statement to see how you've been saving. Then after that, they will look at the legality of your business. Are you borrowing as an individual? Are you borrowing as a company that is incorporated? Is it a partnership or it is a sole proprietorship? Very important along the way. Now, after looking at that, then they will look at the need for the money, not collateral. Please note that I have not mentioned collateral yet, because as banks, usually collateral is the second way out. What they lend to is cash flow. You may ask, at the end of the day, I'm still growing my business. It doesn't have enough cash flow, and you're asking me for cash flow. We look at your run rate, the rate at which the business is growing, and where you want to invest, and then advise accordingly on what you need. Sometimes you do not need to borrow. If you're into supplies, most probably you need a performance guarantee, you need a payment guarantee, or any other form of instrument that will enable the person that you're dealing with to be able to give you goods on credit so that you're able to resell the same goods and you take the difference. Sometimes you may not really need. That's why the purpose is also extremely important. Thereafter, after you have delivered all that is required, they have looked at your cash flows. And of course, the cash flows are seen in your audited books of accounts. If you're a sole proprietor and you don't have them, we'll look at your account run, how the business has been moving. And then definitely it is presented to what we call a committee within the bank that approves your facility. Thereafter, you'll be given a letter of offer, and then they will perfect putting a mortgage in your title, and then they'll give you the money, and then we'll do what we call post-disbursement, that is follow-up to ensure that you pay on a monthly basis. The key takeaway out of this is, please, even when you get challenges, when you take the facility, make sure you're in touch with the bank. We usually have a tendency of trying to hide from the bank, yet you are partners. it is extremely important that you remain in their face. It does no harm even if you have no money at the moment, but please keep in touch, tell them what is happening, and then you see how your business grows. That is it for today's episode. Looking forward to more fruitful engagements with you in the upcoming episodes where we get to learn from each other along the way. Please stay tuned and continue watching us.